Howdy, Team 42. It's your skipper here, Darius Dale, to present our macro minute for Wednesday, February 19th, 2025. As always, we'll start with the executive summary from today's lead off morning note. If you would like to review the analysis supporting these conclusions, as well as what specific changes you need to make in your portfolio to remain on the right side of market risk, you need to be a client of 42 Macro. So today's key macro question is it time to tune out headlines from Mar-a-Lago? Our answers are asset markets are starting to think so. Therefore, we have to ask. Yesterday, President Trump threatened another round of 25% tariffs, this time on auto, pharmaceutical, and semiconductor imports, to be implemented on April 2nd, one day after the joint global trade and currency policy review by the Departments of Commerce, Defense, State, and Treasury, and the U.S. Trade Representative is due. This latest tariff threat follows a hodgepodge of tariff threats from President Trump over the past month. It increasingly appears President Trump lacks a coherent strategy for tariff implementation. That is likely why asset markets continue to call President Trump's bluff on tariffs. The U.S. dollar is not the only market that has essentially traded sideways for a while. Rather than selling off amid fears of stagflation and a retaliatory trade war, the S&P 500 is essentially at the same price as in early December. There are many other indications of analysis paralysis contributing to violent short-term price swings amid stable medium-term trading ranges across macro markets. The only way for investors to generate sufficient returns amid so much noise is to only respond to changes in signal. At 42 Macro, signal equals a row phase transition in the market regime or a change in the volatility-adjusted momentum's condition of a particular asset. And for those who may be unfamiliar, row phase transition just means you're going from a risk-on regime to a risk-off regime, or risk-off regime to a risk-on regime, which is where you have to have the most significant change in your portfolio from an asset allocation and portfolio construction perspective to remain on the right side of market risk if you want to keep making money. Getting back into the executive summary, retail investors should consult our flagship KISS portfolio construction process to accurately and profitably separate signal from noise. Professional investors and sophisticated retail traders should consult our discretionary risk management overlay to accurately and profitably separate signal from noise. The emphasis on separating signal from noise. Transitioning to our 42 Macro community, as always, we'll wrap up with a question from our client base here. The question is titled, sold the business, now what? Question, sold the business, have multi-million-dollar account to invest. Do I wait to go T-bills, or am I okay moving into the KISS portfolio, even considering values are at all-time highs? So a couple things. Number one, congratulations. Really awesome for you and your family, and kudos to all the hard work you put in to build that wealth. Number two, everything I say from here on out is general and not to be construed as specific investment advice for this particular client. Nothing we say ever is specifically specific investment advice for any particular client or group of clients. So investors need to be aware, unless of course you're a pro-to-pro client, which of course you need to be an accredited investor to participate in our pro-to-pro program, which is our institutional client relationship. Although we have quite a few investment advisor pro-to-pro clients, as well as a couple of individual investors who are obviously very rich. So let's get back to this, and maybe this person might be interested in our pro-to-pro service. But broadly speaking, I think the general gist of the question is, we're at all-time highs in markets. I got a bunch of cash to invest. KISS is fully invested right now. What do I do? Do I chase the fully invested allocations, or do I, T-bill and chill until we get a significant drawdown in asset markets to put money to work? In our opinion, I think that kind of market timing, sort of, I would say emotionally driven market timing, is usually a very, very big detriment to your compounding returns over a long period of time. And this is what a lot of investors have missed over the past couple of years. We've kept our clients on the right side of the raging bull markets, generally speaking, since January of 2023, when we made our structural bullish pivot. And, a lot of investors have been, worried about a recession or this or that. And ultimately, the cash allocations in a lot of investor portfolios have been way too high, considering the returns that we've experienced in broader risk asset markets. And so, to me, I think the coaching here for, a general investor to learn from is that, just because the market's at an all-time high, looking at stocks, for example, doesn't mean you should not be fully invested. Using the S&P 500 as an example, the S&P 500 spends 60% of the time within 5% of its all-time high. 60% of the time, this is going back decades, 60% of the time within 5% of its all-time high. I want to say on average, there are about 20 new all-time highs per year in the S&P 500. And so the reality is, as an investor, you should not fear all-time highs. What you should fear, going back to what we talked about in the executive summary, is a row phase transition or a bearish breakdown in the volatility adjusted momentum signal condition of the assets you are attempting to allocate assets to. That's what matters. So whether you are, you go from, you have a bunch of cash to invest and you go fully invest it and into any allocation, irrespective of its KISS or Dr. Mo or anything we sell, what matters is the signal. You can be fully invested up until the signal changes, and once the signal changes, you need to do something different in your portfolio to remain on the right side of market risk. And obviously, remaining on the right side of market risk in a bear market is minimizing downside capture. Remaining on the right side of a market risk in a bull market is maximizing upside capture. And I think, just based on our track record over the past throughout 2022 and being, bullish throughout 2023 and ragingly bullish throughout 2024, I think we have a lot of experience in timing markets and keeping clients on the right side of market risk and a world-class track record to boot. So we're proud of that. We're proud of our clients, and we're proud of the sophistication and thoughtfulness of our clients. And also we're proud of our clients at experiencing success in this experiment we call American capitalism. So proud of you, and best of luck risk managing that cash pile into some better allocations, and we'll wrap it up there. So everyone have a wonderful day. We'll catch you back here tomorrow. Darius Dale presenting our macro minute for Wednesday, February 19th. Cheers.